Task 1A, change number 4. Should the owner decide to include the value of her apartment of $540,000 in the assets section of the balance sheet of the business? So what we need to look at is entities. The owner is one entity and she has a house of $540,000. That would, in terms of her personal balance sheet, go in as a personal asset of $540,000. Looking at the business, what she's proposing is to transfer or include that house for $540,000 in the balance sheet of the business. So taking it from her personal balance sheet to the business's balance sheet. However, she would still own it. She's not actually giving ownership of the property to the business. She's just going to put it in the business's balance sheet. So why would you do that? A lot of businesses might do it because it strengthens their balance sheet, makes it look a lot healthier if they're trying to get investors, or maybe going to the bank to get a loan. So what we need to answer is, should she transfer ownership, transfer the property from the balance sheet from her personal entity to the balance sheet of the business? So should or shouldn't she do that? We're going to relate that back to a qualitative characteristic, and we're going to argue that she shouldn't do it. Now, to do that, we're going to use the qualitative characteristic of relevance. So what does relevance mean? It means information is relevant if it influences the decision-making of the user by helping them evaluate past, present, or future decisions, or confirm or correct past decisions. Now, just looking at that, it doesn't really seem to have a lot to do with this particular question. What we need to remember, though, is that relevance actually has two tests. It's got the materiality test and the entity test. So what the entity test means is something relevant to the decision-making of a particular entity? And what that means is the item relevant to the business itself, or is it a personal transaction of the owner, or maybe a transaction of another business owned by the owner? So in this case, we're going to, if the answer to that question is no, we'd include it in the firm's reports. If the answer to either of those questions is yes, it is a personal transaction of the owner or belongs to another business, we would exclude it from the firm's financial reports. So in this case, the answer to the question, is it a personal transaction, is yes, it actually belongs to the owner of this property. So therefore, we should exclude it from the firm's reports in its balance sheet. Let's put together an answer. So we'll follow our procedure by identifying the qualitative characteristic of relevance. We will define it, and we'll just summarize the definition as only information which influences decision making should be included in the financial reports. What we need to do, though, is it's been very vague now, so we need to relate it back to this case study. And what we're going to talk about is really that entity test. So in this case, the owner should not include her apartment as an asset of the business because it's not relevant to the owner, and the owner and the businesses are separate entities. Therefore, the decision-making of the business shouldn't include the property. It's just not relevant to the business's decision-making. Looking at our marks, we're going to have 1 mark for the identification of relevance, 1 mark for the definition, and 1 mark for relating.